In this video, we're going to talk about solo 401k plan contributions for self-employed individuals. These calculations are specific to sole proprietors, LLCs that are taxed as sole proprietors, and 1099 contractors. Whether this is your full-time business or if this is a side job, stay tuned and we'll walk through a few examples and different scenarios of how to calculate those contributions. And please keep in mind that the information in this video is for educational purposes. I encourage you to speak with your financial professionals regarding how to apply this to your specific situation. So let's get started. Let's briefly review the contribution limits. In 2024, the total plan limits for an employee plus employer contributions are $69,000. If you're over age 50, that goes up to $76,500. In 2025, the numbers are a little bit different. So the contribution limit did increase. It's now up to $70,000 for employee plus employer contributions. But there's a difference now depending on your age for those catch up contributions. If you're over age 50, the total plan contributions go up to $77,500. But if you're in this sweet spot, kind of this super funding catch up contribution age between 60 and 63, your total plan contributions can actually go up to $81,250. In our examples today, we're going to talk about 2024 contributions. And our first example here is for a self-employed business. So we have Stephanie. She is a sole proprietor, single member LLC. She is a one participant plan, so she has no full-time W-2 employees. She is under age 50. And she has her own business as a marketing and design company. Now, her self employment compensation, let's say it's $100,000 a year in 2024. And this is her full time business. So she has no other contributions to other 401k plans. And her goal in this situation is to maximize those pre tax contributions and then make voluntary after tax contributions. She wants to fully maximize what her contribution limits are for the year. In this example, as an employee, her pre-tax or Roth contribution, she could choose either one. The limit for her is $23,000 in 2024. So her compensation is greater than $23,000. She can certainly make those full employee contributions. Now, the way the employer contribution limit works, it's based on 20% of your self-employment compensation. And that self-employment compensation comes from line 31 of your Schedule C, less half of that self-employment tax. Now, again, this is specific for those sole proprietor 1099 contractors where that shows up on your 1040. And you're able to do 20% of your self-employment compensation. The limit for her is going to be 20% of that $100,000 or $20,000. Now, she does have the ability to make those voluntary after-tax contributions, which allow her to do what's commonly known as the mega backdoor Roth. These are after-tax contributions. She would be able to do up to another $26,000 in 2024. We subtract out the $20,000 for those pre-tax contributions she made as the employer, subtract out her employee contributions of $23,000, and then that leaves her with the ability to make an additional $26,000 in those after-tax contributions to the solo 401k. She would then put that into a sub account and convert that to her Roth 401k or Roth IRA. Now let's change up the example just a little bit. And in this example, we're going to say our income's a little bit less. It's lower than that overall limit for the year. And we have Ted, who's under age 50 in our example, is a sole owner of an online business. And his compensation this year is $50,000. Now, his goal is to also maximize those pre-tax contributions and make those voluntary after-tax contributions with that $50,000 of self-employment compensation. So how does this change how much he's eligible to contribute? It doesn't change how much he can contribute as the employee because you can do 100% of your income, and his income in this example is still greater than that employee max of $23,000. So his employee contribution, could be pre-tax or Roth, is $23,000 in 2024. The employer contribution is going to be limited by 20% of that self-employment compensation number. So when you look at line 31 of his Schedule C, less half of his self-employment tax, and multiply that by 20%, he is only going to be eligible to add $10,000 as the employer contribution. Now, he can make up the difference though. So if he wanted to, he could then go up to another 17,000. Now remember, you can go up to 100% of your income. In this case, we're trying to fully maximize the entire $50,000 of self-employment income. In this case, he could do $17,000 as a voluntary after-tax contribution. He can't get up to the total 69,000 because remember his income is below that. In our third scenario, we're going to say it's a 2-participant plan. This could be a partner or it could be you and your spouse who contributes in the business. But again, you can't have any other full-time W-2 employees. We're going to say in this example, these 2 participants, they're under age 50 and they have the same goals. They want to maximize those contributions, but they each have $100,000 in income from their law practice. Again, they're taking that from line 31 of their Schedule C on their 1040, less half the self-employment tax for each spouse or partner. And in this example, they're able to do pre-tax contributions up to $23,000 for each person. They're able to do the employer contribution of $20,000, 20% of that self-employment income, and they're able to make those additional voluntary after-tax contributions and convert them through their Roth 401k as that mega backdoor Roth. They're able to get $69,000 for each person into their solo 401k plan. This is a great way to save for retirement, shelter money from taxes, whether that's going in pre-tax and deferring it till later, or that's going in as after tax and it's going to be tax-free as it grows, and then when you take it out eventually as well. In our fourth scenario here, we're going to look at an example where someone's over age 50. In this case, we have Tony. He is a solo business owner in a construction company. He is making $100,000 in his business this year, but he's over 50 and his goal is the same as the other ones. We want to maximize those contributions. So how this looks a little bit different for him is that on the employee side, he's able to, again, maximize those $23,000 in employee contributions, but he's able to make an extra catch-up contribution of $7,500 for the year. His employer contributions, again, 20% of his self-employment income, so another $20,000 on the employer side. And then he's able to make up the difference up to the total limit. And again, remember, it's $76,500 is the total plan limit. And his voluntary after-tax contribution allows for an additional $26,000 in 2024. I hope you found this helpful. Please follow along and subscribe for more tips for business owners to help you save for retirement.